Welcome to the Small Business Tax Savings Podcast, your weekly dose of accounting and tax tips specific to small business owners. You will be on your way to growing your business and paying the least amount in taxes as legally possible. Here's your host, Mike Jesowshek, CPA.
Hello and welcome back to another episode. I am your host, Mike Jesowshek. Today's topic is, what is a Roth IRA and why is it so powerful? Now, IRAs, which stands for Individual Retirement Accounts, have been around for a long time and utilized by many. When most people think of an IRA, they think of a traditional IRA. You put money towards retirement, you get a tax deduction today, and you move on. However, a Roth IRA can potentially provide even more powerful tax strategies, and that's what we want to outline today. But before we start and talk about a Roth IRA, I do want to kind of talk about the basics of a traditional IRA, as many people might not know about them or necessarily know how they work. So we're going to touch on that quick and then jump into the Roth. So how does a traditional IRA work? Basically, you contribute money to a traditional IRA account and get a tax deduction in the year or the year that you're applying that to. The money grows tax deferred until withdrawing that amount during retirement. Withdrawals are then taxed at your ordinary income tax rate. Withdrawals can be taken, or withdrawals that you take before retirement are going to get hit with a tax on those, along with a 10% penalty. And there are some circumstances where you can get that penalty waived, but traditionally, if you withdraw before retirement age, which is 59 and a half, the withdrawals that you make on a traditional IRA are going to be hit with tax as well as a 10% penalty. Now, how much can you contribute to a traditional IRA? It's $6,000 per year per individual, or $7,000 if you're 50 and older, and that's for the tax year 2022. Now, note, there is no phase out. So if both you and your spouse are not a participant in an employer plan, there's no 401k plan or anything like that you participate in at your job, there is no phase out. But it was this the ability to contribute to a traditional IRA is going to start to phase out if you are a participant in an employer plan and you have an AGI gross income of $109,000 if you're married, or $68,000 if you're single. So if you have no retirement plan at work, you can contribute to this, thus up to the $6,000 per year, $7,000 if you're 50 or older. If you are a participant in an employer plan at work and your income is above 109 if you're married, or above 68 if you're single, the amount that you contribute is going to start to get phased out. Now, if you are a non-participant married to a participant, that number is $204,000, so it's a bit higher. Now let's talk about a Roth IRA. With a Roth IRA, you contribute after-tax money to a Roth IRA account. So there is no current year tax deduction. You get no tax break for that contribution that you're putting into a Roth IRA. That money grows tax-free, and here's the key thing. Withdrawals are also not taxed. So you don't get a deduction going in. Your money inside of it grows tax-free, and then when you withdraw from it, it's also not taxed. Same thing with a Roth IRA, same thing as a traditional IRA. You can contribute up to $6,000 per year per individual, or $7,000 if 50 or older, and that's, again, the rates for 2022. Now, Roth IRAs start to phase out when you have gross income of $129,000 if you're single, or $204,000 if you're married. So if you're married and you have over $204,000 of income, that $6,000 contribution limit is going to start to get lowered or potentially be completely eliminated. But if you are under that AGI, no problem. So again, a Roth IRA is you contribute after-tax money to it, no current year tax deduction. That money grows tax-free, but then you're also not taxed on any withdrawals that you take on it in retirement. And same thing with a traditional, you can begin withdrawing at age 59 and a half for a Roth IRA. So let's talk about why are Roth IRAs so powerful. And we talked about one already. Distributions are tax-free. The money you take out of it is tax-free, and that's both principal and the earnings that you have in there. So since you do not get a tax deduction going into a Roth IRA, you get to enjoy tax-free growth and tax-free distributions. With a traditional IRA, you get a tax deduction on the amount you contribute, but upon withdrawal, you're going to pay taxes on both the contribution amount and the earnings. So that's the key thing about the Roth. Distributions, both principal and earnings, are tax-free. Another really cool thing about a Roth is that you can withdraw your contributions, not your earnings, but the amount that you contribute to the Roth IRA without penalty. So with a Roth IRA, you're able to withdraw any contributions or the principal amounts tax-free and without penalty. So let's kind of go through an example of this. Let's assume that you contributed $6,000 into your Roth IRA for 4 years. And then 8 years down the road, you get hit with a financial burden and you need some cash. You can take out $24,000, that $6,000 that you contributed for 4 years. You can take that out of your Roth IRA without facing any tax or penalty. Now, it's important to note, though, that any interest you may have earned within the account during that time, you cannot withdraw without penalty until retirement age. So that interest portion, you'd have to leave in there until retirement age. But the amount that you put into it, you can withdraw early if you need to. Now, again, we would never advise someone to touch a retirement account to access funds, but with the Roth IRA, at least you know it is an option available for you. The other nice thing about Roth IRAs is that you can leave amounts in your Roth IRA as long as you live. There's no required minimum distributions. So with a traditional IRA and many retirement accounts, the government requires you to start taking minimum distributions. They call these RMDs, or required minimum distributions. And this starts around the age of 72, where you're required to start withdrawing from your retirement accounts. With a Roth IRA, you are not subject to RMDs. So those are kind of the three main benefits of why Roth IRAs can be so powerful. Now, we talked about earlier that if you're over a certain income limit with a Roth IRA, you might be phased out where you're unable to contribute it. So we want to talk about what happens if you phase out of a Roth IRA. And there's some cool things. There's an option for you, at least for the time being, that could change with recent legislation, where there's been recent legislation that wants to remove the backdoor Roth IRA option. But as of writing, this is allowed, and they call it a backdoor Roth IRA. And so how does this backdoor Roth IRA work? First, you open a traditional IRA and make a non-deductible contribution, which basically means you get no tax deduction for that contribution. You then convert your traditional IRA to a Roth IRA, and that's it. You got past the phase-out limits. Same thing occurs. It grows tax-free once you do that conversion. But now with that being said, it can be a little bit more complicated than that quick explanation that we gave. And so there's some factors that you need to consider. You can actually convert prior traditional IRA accounts to a Roth IRA too. However, if it was a deductible traditional IRA, you're going to need to pay the taxes on the value of the account in the year of conversion. So let's say that you had a traditional IRA from 10 years ago, and it's growing. This was a deductible one, and you say, I want to convert this to a Roth. Great. Under current law, you can do that with one caveat. In the year that you convert it to a Roth, you need to pay the taxes on that conversion, because then it's going to grow tax-free moving forward. So a lot of times that can be a big hit of taxes, and that's why a lot of people might not look into this. And that's where we look at the backdoor Roth, because with the backdoor Roth, we do a non-deductible contribution, then right away convert that traditional IRA that we created with that non-deductible contribution, right away we convert it to a Roth IRA. Now, if you have deductible traditional IRA funds, you need to convert the pro rata portion of those two, which could lead to a tax sting. So let's say we had a traditional IRA account of $100,000 that was from years and years and years ago. And let's say you're like, this year I want to do a backdoor Roth because my income's too high. And we put $6,000 into a non-deductible traditional IRA. When we try to convert that, we need to convert the pro rata share. So we need to convert some of those traditional old ones that we've had along with our new one. So it's not we don't get to pick and choose which ones we want to convert. It's going to be the share of non-deductible and deductible ones. So as we kind of mentioned, this can create somewhat of a tax sting in some years if you had prior traditional IRA accounts opened. So I always say is either way, if you're planning on doing this, reach out to your financial advisor, whoever manages your account, along with your accountant to go through the scenario. Find out, is there any kind of tax liability you might have? If so, what is that tax liability? And kind of go through that. Now, if you don't have any traditional IRA accounts at all before this, but you're looking to do a backdoor Roth because your income's too high, not a big deal. It's pretty straightforward. But it's for those people that have older traditional accounts that you want to be specific and know that you're doing it correctly and kind of running through the numbers first. All right. So what else should we know about Roths? And here's a cool thing. Whether you're a business owner or not, a Roth IRA is an option for you. It's not specific to business owners. The IRA limits are per person. So if you are married, it would be the yearly limit times 2, again, assuming that you qualify. Based on qualifications, you can contribute to a Roth IRA over and above any 401k contributions. So let's say you are contributing to a 401k, you can contribute to a Roth as well. So if you have a 401k with your employer, you can do the 401k plus the Roth. Now, with a Roth IRA, you're subject to that yearly limit, that's $6,000. But if you are a business owner, you may want to look at a Roth Solo 401k. This takes this concept of a Roth so much deeper, allowing you to put more and more money into it over and above that $6,000 limit. Now, if you have other employees outside of you in your business, the Roth Solo 401k may not be a good option for you. But if you're the only business or the only employee in the business or maybe some family too, you might want to look at a Roth Solo 401k if you really want to put a lot of money into this Roth idea. And we always say Roth accounts are great for those investments that you expect large returns on because you're not paying any taxes on the growth and future withdrawals of that money. So earning 5% in an account is great, but imagine that you had an investment that you expect to earn 15% or 20%. A Roth IRA would be a great place to put that because the earnings and the growth on it and the future withdrawals are tax-free. And this is really where self-directing your Roth IRA account may be a great option for you. If you want to invest in real estate, you want to invest in crypto that you think is just going to take off, Roth IRA would be a great place to do it because you can invest. Let's imagine you were one of the original Bitcoin and you bought Bitcoin at $200. At one point, it was at $50,000. But let's say you bought it at $200 and it went to $50,000. That's a massive, massive, massive gain in there that you're not paying any taxes on that gain or the future withdrawals of it. So again, typically Roth accounts are great for those investments that you expect a large return on. And another thing is if you're hiring your kids in your business, which is a great strategy that we always recommend, you could have them contribute their earnings to a Roth IRA. This is a great retirement account setup, and should they need those funds in the future, they're able to withdraw those contributions. So let's say you're paying your kids $10,000 a year. They're 12-year-old doing some business and doing some work in your business. You're paying them $10,000 a year. They could contribute $6,000 into their Roth every single year. Great retirement account they're building up. But let's say they get to college and they just need some funds one year. Well, with the Roth IRA, we have that great option because remember, we can withdraw our principal or the amount that we contribute to it. So again, we would never recommend that. We'd say, let's let this thing grow and grow and grow tax-free for as long as possible. But it's a great idea or option that we know if we do need some funds, if we hit a bind, we have funds that we can easily access. So that's kind of the Roth IRA. Why is it so powerful, what it is, and things like that. I just want to do a quick summary going through what we've talked about today. A traditional IRA, how they work is you contribute money to it and get a tax deduction in the current year. That money grows tax deferred and then is taxed at your ordinary income tax rate when you withdraw it in retirement. There is a penalty if you withdraw anything from it ahead of time, and you also pay tax on it, but you can begin withdrawing from a traditional IRA at age 59 and a half. The amount that you can contribute to a traditional IRA and a Roth IRA is $6,000 per year or $7,000 if you're 50 or older. That's the 2022 rates. Traditional IRAs do have some phase outs, especially if you're a participant in an employer plan. Now, with a Roth, you contribute after-tax money to a Roth account, so you don't get any current year deduction, but the money grows tax-free and withdrawals are not taxed. And then you can begin withdrawing everything at age 59 and a half. Again, if you have income over $204,000 if you're married or $129,000 if you're single, they're going to start to phase out, which is when we're going to want to look at a backdoor Roth IRA. And basically with a backdoor Roth IRA, we open a traditional IRA and make a non-deductible contribution, which basically means you get no tax deduction for the contribution, just like a normal Roth. And then we immediately convert that traditional IRA we created into a Roth. Great idea, really helps out. But remember that if you have prior traditional IRA accounts opened, you might want to talk with your financial advisor, run through the numbers to see if this makes sense. Now, the three reasons that Roth IRAs are so powerful is that distributions are tax-free. That's both principal and the earnings within it. You can withdraw your contributions, not your earnings, but you can withdraw your contributions early, prior to retirement, and without penalty. And then you also have no required minimum distributions with the Roth IRA. So you can leave the amounts in your Roth IRA as long as you live. Now, some other things we should know is that traditional IRA and a Roth IRA are available to business owners or non-business owners. And the IRA limits are per person. So that's $6,000 or $7,000 per year is per person. So if you're married, it'd be times 2. And traditionally, as long as you make the qualifications, you can contribute to a Roth IRA over and above any current 401k contribution you might have with an employer. One thing that we talk about with business owners is doing a Roth Solo 401k. Again, this takes this concepts of a Roth and just allows you to put even more money into it if you want to put in more than that $6,000 limit. And again, Roth IRA accounts are great for investments that you expect large returns from. Any Roth account is great for an investment that you expect a large return from. And we also love to combo this with hiring your kids in your business strategy, because they can have your kids then contribute to a Roth IRA. All right, cool. So just some housekeeping items. If you're interested in learning about more retirement plans, things like that, of course, join our tax minimization program, where we have a library of tax strategies and implementation guides. You have unlimited access to our team. We're kind of that accountant in your back pocket. Have a question about something, you just shoot us an email. We'll respond to it. You have unlimited access for those general accounting or tax questions. We also do monthly group training and so many things. So if you're interested in our tax minimization program, go to taxsavingspodcast.com/tax. We're also going to be having a webinar on May 4th at 1 p.m. Central Time, 2 p.m. Eastern. The webinar we're doing is 2022 tax strategies to ensure business owners pay the least amount possible. You can sign up for our webinar at taxsavingspodcast.com/webinar. That's taxsavingspodcast.com/webinar. And again, we're going to have that Wednesday, May 4th at 2 p.m. Eastern Time. We're going to be talking about top 5 tax strategies you need for 2022, how to implement them, tax planning versus tax paying, how do you grow your business, how do you develop a bookkeeping system, and so much more. So don't forget to join that webinar. Also, don't forget our Small Business Tax Savings Summit is coming up June 14th and 15th. It's going to be a virtual event. We're going to go have 2 days worth of content, over 12 hours of stuff. You're going to love this. We're already prepping and really have most of the content worked out, just putting some final touches on it. You're going to love this. Go to taxsavingspodcast.com/summit, taxsavingspodcast.com/summit. And as a podcast listener, you can get $100 off registration if you use the promo code podcast taxes. That's all I have for today. I want to thank you for listening to another episode, and make sure you take care of your Roth IRA, and I will see you guys next week.
This has been another episode of the Small Business Tax Savings Podcast. If you enjoy our weekly episodes, please leave a review and share with other business owners. You can find previous episodes and more information at www.taxsavingspodcast.com. Thanks for listening and have a great day.